money grows when it's in motion. Like that's prime example is you put it in the bank. It doesn't grow at all. It loses value, right? You put it in a 401k. You're parking it somewhere. Like you don't have control of it. Wall Street has control of it, right? So just money needs to move in order to be in motion. And I'm glad you brought up retirement actually, because policies, if they're structured properly, can be like the best retirement income ever. Yeah.
Look, pull in the spot. Ooh, watch how I drop. Believe it or not, this isn't all that I got. They told me to rock. That's not how I rock. Now I gotta pop Madonna.
Hey guys, welcome to the Flip Lab. In this episode, I got my buddy Devin Burr here. Devin's story is pretty interesting. A couple years ago, we actually met when we were first getting into real estate. We went on a buy appointment together with our buddy Templeton Walker when we were first starting to learn how to do real estate. That's where we first met over 2 years ago when we were still working corporate jobs. Fast forward a couple years later, now Devin owns millions of dollars worth of real estate using creative financing strategies that we're going to talk about, how he kind of got the name Mr. Burr. And also now he's heavy into life insurance, and he's super passionate about being your own bank, finding creative ways to multiply and compound your money. So let's kind of get into it, man. Welcome to the Flip Lab.
Thanks, bro. Appreciate you having me.
Of course,
and
man.
Yeah, I'll never forget that day, our first buy appointment, bro. It's crazy. Like literally didn't know what the hell was going on. And shout out to Temp. Took us under his wing, man, and here we are now. So appreciate you.
Yeah,
appreciate you too, Temp, if you're watching.
Like full
this.
Circle, dude. He was on the show last week. Now you're on, and
Nice.
seeing where we're all today, probably would have never guessed it when we were on that buy appointment a couple years back.
100%. It wasn't even a couple of years ago. It was like a year and a half.
Year and a half, right?
Yeah.
Crazy.
Goes by quick.
It does.
Yep.
So
thanks for having me.
Tell the people what you got going on right now.
So I got into real estate a year and a half ago, and basically went on that buy appointment. I kind of fell in love with just having mobility, not being behind a desk, right?
Yeah.
And I saw like what my potential could be, because with Temp, like me and him go way back. He actually worked where I used to work, and he was doing big things in real estate. So I'm like, that's my potential. I could do what he's doing. So I just really jumped in and quit my job in October of 19, started wholesaling, did some flips. From like January 20 to when the pandemic hit, I did like 8 deals, all from just networking. So 0 marketing dollars. So I'm sitting here thinking like, hell yeah, I found my thing. Like I'm going to crush it in real estate. And then the pandemic hits and like meetups go away. And that's where I was getting all my deals. Right. So I'm like, all right, well now what do I do? Everyone's on lockdown.
We spent a lot of time golfing.
We did spend a lot of time golfing. I got somewhat good at golf.
Yeah.
But
not a lot of business though.
No. But aside from that, like I'm just sitting in lockdown, like what am I going to do? Like how am I going to still get deals? Right. Was listening to podcasts, reading. I heard a podcast with this dude Chris Nagel on it. He's talking about becoming your own bank and, funding deals and like getting away from actually giving money to other people with interest. So I'm like, sounds interesting.
And you were in the mortgage business for a long time, so you probably already kind of had that mindset
right
about financing.
Right, because mortgages is really, it's the velocity of money. What people don't understand is like when mortgage rates go down, they see like a 1.99, 2%, and they're like, oh my gosh, I got to get that.
Right.
But they reset the clock. So they pay all the interest at the front of the loan. So mortgage companies and banks, they want you to refinance into lower interest rates because they're resetting the clock, getting more interest over time.
Makes sense.
The rate doesn't actually matter. It's the velocity of the money. So I understood that. And then once I like dove into infinite banking, which is just becoming your own bank, I was like, this makes a lot of sense. I got to learn more about this. So I contacted Chris and I just dove straight in. I started a few policies. And then once things kind of loosened up with COVID and, deals started coming in again, I started just funding those deals with my policies. So I literally became like the private money lender for myself. I was no longer paying someone else 15% interest, 18% interest. I was just borrowing it for myself. If I'm okay paying them, I'm okay paying myself the same amount. See what I'm saying? So
yeah,
it worked out well.
So you're essentially just your own bank.
Basically, yeah.
Why do you think more people aren't their own bank and we use banks like Wells Fargo and Chase?
I think it's just because what we're taught, right? Like when you're taught when you grow up a couple of things, which I think are ridiculous. Taught to go to school, get good grades, get a good job, or actually first go to college, right?
Yeah.
Have a whole bunch of student loan debt.
Get yourself in debt.
Yeah. Get yourself into a lot of debt. Hopefully find a good paying job. Work your way up in that job. As you work your way up in that job, what happens? You make more money, so you pay more taxes because you get into different tax brackets.
Then buy a house, getting more debt, buy a car, getting more debt.
Right. So you're literally just giving your money to someone else first. 401ks. Before you ever get the money comes out of your check. Before you ever get the money, taxes come out of your check. So we're taught to basically give up all of our money to someone else, cars, houses, 401k, taxes. And then after all that's done, we're left with a small portion. We're taught to put that in the bank and save it, which might have been a good thing back in like the 50s and 60s. But 1971, the dollar was taken off the gold standard. So money legitimately became debt at that point because the feds can just print money at any time and just go into debt.
Yeah. So
money is debt now. So basically, we're taught to put our money in the bank. Inflation is ridiculous. It's like 3% a year.
Like, right? 3-4% this year.
This year's probably more, but average is about 3%. And banks pay you 0.06% on average. Less than 0.1%. But that's what we're taught to do. So like, prime example of it is, and I don't want to offend anyone here, but in Arizona, mask mandates have been lifted, but you still see everyone trying to wear them because everyone just wants to do what everyone else does.
Right.
It's human nature.
They want to just be safe in the safe zone. If everyone else is doing it, it's probably a good idea. That's what I should be doing.
Right.
So people have been doing that with money for the last 100 years or whatever.
Right.
With banks.
And I did the same thing. Like I would just put money in bank and I would have a 401k. I just didn't know how money really worked. And once I figured that out, the rest was history. Now, like I see long-term where my money's going to be, and it's crazy.
I think where people are getting skeptical, maybe when they're hearing about this, is we're used to like money. It goes into a bank. It's this account. Our money's safe there. And then when we want to spend money, we take it out. Like that whole thing makes sense. What you're talking about though, is utilizing life insurance policies to become your own bank. And I think that's where maybe some people, they hear that. They think, is that illegal? Are you supposed to be doing that? What's the catch?
Right.
So how do you answer that? Because I'm sure, you're writing policies, you're talking to people about this a lot. How do you answer those questions that come up?
Well, first, it's been around for several hundred years. So it's definitely something that's not new. Life insurance has been around. I think the first policies were done like 250 years ago. Mm-hmm. So they've been around a long time. The companies that we write with have been in business for over 150 years. Very, very stable companies, profitable every year during that time frame. So through the Great Depression, through the Great Recession, through COVID when it hit, when everything else got messed up, these companies are still profitable. So it's not new. It's liquid. So a lot of people think, I'm gonna put money in the bank because I can just go get it out, right?
Yeah.
But think about money that you put in the bank. Let's say you got 10 grand in there, right? You're making 0.06%, big whoop. But if you take the money out, you're no longer making that 0.06%, right? So yes, you can get it out anytime, but then it loses its ability to make money, right?
Yeah.
With life insurance, it's just completely different. You put the money into a policy, it's guaranteed to grow for the rest of your life at 4%. So already right there, you're miles ahead of any savings account, right? You can then use that money and it still grows at 4%, guaranteed. So your money in a policy is basically just collateral. Like you get it as collateral, let's call it 10 grand. And then you borrow against your future death benefit. So you borrow against that, your money's collateral. So it just stays there growing. You borrow the insurance company's money from your future death benefit. If you never pay it back, death benefit goes down. So you just have full control of your money. It's 100% liquid, 100% safe, because it's a contract between you and the insurance company.
Why, when you see like life insurance commercials and like marketing for insurance, why don't you ever hear them talking about the way to use life insurance in this way? It's always just like, hey, one day you're going to die. You should have life insurance for your family in case something bad happens. But they never talk about, hey, you could finance your car. You could finance houses. You can use this method for infinite banking. Why isn't it marketed?
Dude, such a great question. First off, like when I first would think about life insurance, I would always think, I don't need life insurance. I'm young, I'm healthy.
That's me. I'm like 28, right? No kids. Oh,
that's how most
really
people
need
think.
Life insurance.
And if they do think about life insurance, they think about term insurance, right? Mm-hmm. Term insurance just covers you during a certain time frame. Let's call it 20 years. So let's say you got life insurance on term for 20 years. It'd be over when you're 48. You're probably not going to die before you're 48.
Hopefully not.
The likelihood is very, very slim, right? Mm-hmm. And the insurance company knows that, right? They're betting on you outliving your term, because then all that money just went to them. They get to keep it. But that's the most popular thing, is term.
Okay.
Whole life isn't popular because you have to put more into it. It's more expensive. And if it's structured for the death benefit, which is what most policies are structured for, it's very expensive and you don't have access to your money. And the agent gets paid a ton of money, a lot of commission. Like, full transparency to you, bro, if you were to put in like 10 grand into a policy per year on a regular policy, just off the shelf, mm-hmm. not for infinite banking, I would probably make in the first year 10 grand. I'd literally get all of it, which is crazy.
Yeah, that's nuts.
And that's why I think it's got a bad name, because most agents, they want their commissions, right?
Yeah.
So they want to sell you a policy that's in their benefit, not yours. Whole life is really just, if it's structured just off the shelf, it's good for someone just in case they die at any point in their life, right? Their beneficiaries will get a death benefit. But the way we structure it, it's just completely opposite. We don't structure it with a high death benefit. We structure a low death benefit, high cash value. So basically you just have access to all your money. And the reason why it's not really marketed or whatever is because the commissions are lower.
Makes sense.
Yeah. What agent has like an incentive to sell something where they're going to make 60 to 90% less commission?
Now, do you think, that obviously makes sense. It's sales guys, they're always pushing stuff that they want to make more commission off of. It is what it is.
Right.
But as far as when you look at the average person, the average American, not talking about like the Rockefellers. I know they've been using, life insurance to build their wealth for generations. But like the average Joe, 50K W-2 earner, all of a sudden, he's making some money. Should he get term life insurance or should he do whole life insurance? What do you think for the average person is a better fit for them?
I think it just depends on a couple different things. So one being just extra money. Like, can you save any extra money right now? Like, if you're literally check to check and you've got like $10 afterwards, you just can't afford to put into a whole life policy, because you need to be able to put, I tell people this all the time, at least your age times 10 per month for it to work. So for you, it'd be $280 a month. Like, if you don't have $280 a month, you either need to cut back and find it to do it, or get a term policy, which is like $15, $20 a month.
Now, the average person that works like a W-2 job, right? They're making 50 to 80 grand a year. Mm-hmm. They look at their retirement and their savings. Usually what they do is they match their 401k, right? That's like the typical thing you hear people do. Oh, what's your retirement plan? Oh, well, my company matches my 401k. That's where I max that out every year. And that's where they're investing their extra money goes. Mm-hmm. Would you tell people to continue to do that, or should they take control of that themselves?
I would say 100% stop putting into a 401k. Like, once I learned how this works.
Even if they match?
100%. The 401k is the biggest Ponzi scheme there is. If people stopped putting into 401ks, it would just go away. Legitimately. Because if you think about, even with a match, right? I'm going to give up my good dollars right now. Money is the most valuable today. It's proven. Inflation is just going to keep going. The dollar's going to be worth less.
It's meant to be used, not saved.
Right. So money today is more valuable than money tomorrow, right? I am 36. I would be eligible to use my 401k if I had one at 59 and a half. So 23, let's call it 23 years from now. In 23 years, do you know how invaluable, would that be the right word?
Yeah. Invaluable, not valuable.
Not valuable. Right. Whatever. It just wouldn't be worth much. $1
Right.
wouldn't be worth anything hardly.
Yeah.
It might even be cryptocurrency at that point, right?
Who knows?
Right? So by doing a 401k, you're giving up your money's most valuable time, which is right now, to have access to it later when it's worth less. So let's just talk about the match. You put in $1, they match $1.
Mm-hmm.
Cool. You got $1, but you don't have access to it until it's worth hardly anything. Not to mention, you're paying taxes on the harvest, not on the seed. You're deferring taxes on that money, right? Do taxes go up or down?
Up, from what I've been seeing.
Always, right?
Right.
And if they don't go up, they just figure out more stuff to tax us on,
Yeah.
right? So you're giving up the most valuable dollars today to have access to them later. Even if it's a match, you're getting dollars that are worth less. You'll be taxed more, and you're getting taxed on the harvest, not on the seed. Like a 401k just makes no sense.
Yeah. I mean, it was crazy when I left my W-2 job. I was just like, fuck this 401k thing, liquidating my money. Like the amount of fees I had to pay just to get my own money out of that were like crazy. And I didn't have that much because I worked at a company for like 2 years. But the average person though, that is their extra money. That's like their retirement plan.
Right.
You look at a guy like my dad, he's 62. He's house just got paid off. They're about to sell it. He's been maxing out his 401k, makes, about $100,000 a year, always lived below his means. He's retiring debt-free. In a year from now, going to have about $1 million liquid. But he nailed the plan. The game plan that they set up, right? Match your 401k 100%, live below your means, save, do all this, pay off your house in 30 years, which he actually did. Most people don't actually pay off a 30-year mortgage. And he's about to retire, and he's worried about retirement. For $1 million, when he was started it 25 years ago, 30 years ago, oh shit, if I have $1 million when I retire, I'll be good.
Right.
But in today's world, $1 million is not that much. That's not enough money for him and my mom for the next 30 years or whatever to live off of.
Right.
So he needs to still now, after he retires, figure out how to invest, how to really set himself up for retirement. And that was someone that executed game plan well for 30 years and it still didn't work out.
He needs to move his money. That's what I've learned is like money grows when it's in motion. Like that's prime example is you put it in the bank. It doesn't grow at all. It loses value, right?
Mm-hmm.
You put it in a 401k. You're parking it somewhere. Like you don't have control of it. Wall Street has control of it, right? So just money needs to move in order to be in motion. And I'm glad you brought up retirement actually, because policies, if they're structured properly, can be like the best retirement income ever. Because you put money in, it's guaranteed to grow. You can take the money, go make other investments, make more money outside of your policy while your policy grows tax-free, 100% no taxes. You make money outside as well. As it grows and it grows and it grows, come retirement time, you can start taking from it tax-free. So you're paying no taxes on it because you're just getting a loan against your future death benefit. Loans aren't taxed, right? It's not a taxable event. So you just take loans against your future death benefit. So you're basically using your capital to have a retirement income. And the beauty of it is, even if you use it, your baseline stays intact. So it just keeps growing, even though you're using it. Like best retirement vehicle there is.
What about now? Like the average American, let's say they make 60 grand a year after taxes, let's say they have $10,000 a year left over. Right. I think that's kind of, I haven't looked at the statistics, but I think the average person might, if they live below their means, did the right things, might have like $10,000 to put away towards investing into something.
Not even close. The average is 5%.
Yeah. Well, I'm talking if someone does the right things.
Okay.
So like they don't buy the expensive Gucci shoes and
Okay.
they live below their means. Like, but they just don't make that much money. Like, it's not realistic that everyone you talk to, their active income is going to be 250K plus, right? The average active income, whatever, let's say $50,000. Let's say they can save $5,000 to $10,000 of that per year. If they can only put away that much, you still think it's a good idea for them to open up a policy, or are there too many fees involved in the policy itself where maybe if like you don't have enough money to put into it, is it not a good investment?
No, I do think it's good because one, it's not an investment. That's what people need to understand. I get that a lot. They're like, that's not a good investment. And I agree because it's not an investment. Like investments have the risk of losing money, right? You can't lose money in a policy. It's guaranteed to grow every single year. So that's the first thing. It's not an investment. It's a savings tool that gives you just benefits that no other savings tool gives you, right? And I think 100%, regardless of how much you have, if you have extra, it needs to go there for a couple of reasons. One being you have total control. Two, it's liquid. Three, fees stay the same. So like if you put $5,000 into a policy, you'd have access to the first year about $4,000 to $4,500. The difference is your fees, not that high.
Right.
That's going to stay exactly the same, but your growth is just going to keep growing. So mistake I find a lot of people making is they want to get more money, they want to make a bigger return, right? And when you try to make a bigger return, what happens?
It's riskier generally.
Risk goes up, right?
Yeah.
So everyone's like, let's go to the moon with Dogecoin.
Right.
And then what happened?
Well, when it drops 50% or 100%, it's like, well, what did you think was going to happen if it could go up that fast?
Right. So there's a lot of risk when you make bigger returns. Really, all you need to do is get rid of eroding factors in your finances, which is taxes and interest to other people. If you can just get rid of those two things, you don't need to make a bigger return. You can make the same exact amount of money, but more of it's just staying with you. What I mean by that is, again, everything in a policy is tax-free. So you're getting rid of the taxes right there on all the growth, right? Let's say you've got 10 grand in a policy. You've been putting in there, but then you've got some debt. So you got a $10,000 credit card and you're paying 20% on that.
Yeah.
So you're paying 20% to the credit card company. If you just take your policy, pay off the credit card, pay that 20% back to yourself, what are you doing? You're getting 20%.
Right. You're eating that interest back to yourself.
You're getting the interest, right? Not them. So you just went from the average savings rate in America is 5% of their income. If you're getting back 20%, you literally just got more savings, and all you did is directed your money back to you instead of to them.
And I think enough, like the average person, they spend so much time trying to save, right? Cut costs. Let's not get Starbucks. Let's make our own coffee. Let's not go out to eat. Let's do this. And it's like, you can only save so much money per year. But I feel like at the same time, those same people put very little thought into what you were just explaining as far as trying to move your money where it's growing continuously, even if it's not this like huge, massive return.
Right.
But people will tend to focus way more on cutting out enjoyments out of their life to try to get in a better financial position instead of trying to take a little time to think of creative ways to grow their money while it's just sitting there.
Recapturing money that you're paying other people. It's the easiest way.
So like right now I have in just like a checking account, like 60 grand just sitting there, pretty much like pays my bills every month in case I want to buy something. It's just like cash, to fund my life. Would you recommend putting that all into a whole life policy and then paying for my life through the whole life policy?
100%. Here's why. Because since you own a business, right, the policy is under your name, right? So you put 60 grand in, you'd have access to whatever 90% of.
Can I put that 60 grand in right away into the policy?
Yeah. You can just dump it in.
Okay.
So you'd have access to up to about 90% the first year. However much.
So I say, Devin, here's 60K from my Wells Fargo account, put it into a whole life.
Right.
You make the policy, a week later or whatever, I have access to
90%. So that'd be like 54,000.
Okay.
Give or take. Right. So what you could do is you could take from the policy whatever you need for the month, let's call it.
Credit card bill comes, it's $3 grand, got to pay it off.
Right. So you could just take that out and then it goes into your Wells Fargo or wherever. Now all you do is you lend that money to your company. So you create a note, for whatever you generally pay for interest on things. So it can just be a handwritten note. I type them out, sign it, kind of geeky, like just in case the IRS tries to like audit me, right?
They're watching.
But basically, like I've got proof here. Like
Right.
this is
That
a
you made it.
note
Yeah.
from me to my LLC. Now you can write off the interest you're paying on that loan from you to the LLC. Money just goes right back into your policy. You get a tax write-off. But the only thing you did different is you just put your money into a place where you have control of it. It'll grow even if you use it. It's the only difference.
Yeah. So in this, let's say this past year where that 60 grand has just been sitting there, not really doing anything, just fluctuating, a little money goes in, out of it. But I've earned like no interest on it. Whatever the bank pays, 0.00 whatever percent. If that was in a life insurance policy, I would have made about 4% of it this year, right out the gate, right?
Plus dividends, those just aren't guaranteed. They're about 2% usually.
Okay, plus dividends. Then my policy, I mean, it gets, like, especially if you start at a young age, I was looking at some like of the 10 years and stuff, like it gets good if you start in your 20s. By the time you're 50, those dividends are really paying a lot of money at that point.
They're silly. Like I tell people, I always use my policies because I know them very well. They're my policies. And like one of them is $125,000 a year for 10 years. After 10 years, I can't put that much in it anymore.
But I was looking at a 10 pay. Yeah.
It's overfunded at that point. If I put more in, I start getting taxed. Don't want to get taxed. So after 10 years, all you can do is put in the base premium, which pays for the death benefit. So that in that policy is $50,000. So at year 10, I put in 50 grand. My cash value goes up by 168.
Damn, that's crazy.
So it literally goes up. I put in 50, it goes up by another 118.
Yeah.
So what's that, 200 and something percent return? Like it gets silly. And that's just year 11. Imagine year 20, year 30, year 40.
Right.
That's why in your retirement years, especially if you get one young, it's just ridiculous as a retirement vehicle to have tax-free income.
Love it. I think it's like something that way more people need to be looking into. And I just think with everything going on, with all this cryptocurrency, inflation, banks being all weird about, we're not allowing you to wire money to Coinbase account. It's like now banks are telling you where I could wire my money to. I just think in the future, alternative places to put money besides a bank are going to become more popular. And I think like looking in a whole life is definitely people should be doing. So
you're going to get one is what you're saying.
I'm going to get one.
Let's go.
I'm going to get one, guys.
Bro, I've been working on you for a while.
I'm going to get one.
I love it.
So Mr. Burr on TikTok, you've become a little bit famous. You have like 500,000 followers. I remember you only got a TikTok because I told you to make one.
This is true.
So shout out to me.
This is true.
But if people want to find you, is that the best way? Or if people want to learn more about life insurance in general, where should they be hitting you up at?
So yeah, my TikTok is a great place. I have a lot of content on there. I created a YouTube. Haven't done much on YouTube just because I've been swamped. So finding time to do it. But YouTube, in my bio on TikTok, I've got a really, really good video that just walks you through exactly how it works. And it gives you like visuals because a lot of people are visual learners.
Yeah.
So it gives you visuals and that way you can really see how it works. And then once you see it, like, at least for me, when I saw it, I was like, I need to talk to someone. I need to like figure this out more. So in my calendar or in my TikTok and the link, you can get on my calendar so we can have a conversation.
Cool. Yeah. I think it's like, I'm pretty stupid, I think. And when I looked into it, it was complicated, but when I actually got it in front of me and looked at how like a 10 pay worked out, it wasn't too bad. So I definitely think, guys, you should totally look into this whole life stuff. I've been skeptical for months, but I'm opening a policy.
Let's go.
Dude, it was great having you on, man. Let's get out on the golf course again soon. It's been a little too long.
Yeah, I'm going to be a little rusty.
Yeah, same, bro. But great having you on, bro.
All right, bro. Appreciate you.